It's a very good question. Just because you can do something doesn't mean that means it's a good idea to do it. When borrowing money, I think people need to put a lot more weight on the risk that they're taking when they're borrowing money to invest in assets. So I think that the way these things should be assessed is the quality of the asset, the reason that gets you excited that you want to own that asset from a return point of view. Is the return going to be good enough to warrant you to take on more risk in terms of more debt, and also the complexities of setting up a self-managed super fund borrowing arrangement. So I would always come back to, is the investment that you're investing in going to give you the return that's going to be cash flow positive? Is it going to provide long-term growth? So investment first, and just because you can do it doesn't mean it is a good idea. So I'd tread very carefully, and I would encourage people to put a lot more weight onto their decisions onto how much debt they take on. Because look, the banks will be happily, as we know, they will happily lend it out to us, and they're happy for us to be in debt for 25, 30 years. That means they're going to get paid a hell of a lot more interest. So is it a good idea? Well, yep, in certain circumstances, yes. But just because you can doesn't mean it is a good idea.